Governance fails silently until it fails loudly. In the earlier modules, we looked at governance as a part of the GRC framework, the big picture direction and oversight. In this module, we focus on what governance looks like in real action. This is where policy turns into decision making and where the board, executives, and senior management actively shape how risk and compliance are managed day to day. We will explore real world cases in banking where governance succeeded in preventing or minimizing a risk, and cases where governance structures looked good on paper but collapsed under pressure. We will also talk about the importance of escalation paths, decision making agility, and making sure the right information reaches the right people at the right time. By the end of this module, you will see how effective governance is not about endless meetings or documents. It's about enabling the bank to act quickly, to act decisively, and in alignment with its risk appetite and, of course, obligations. Now, let's talk about who runs the show. Governance is how we make and enforce security decisions. It's the chain of accountability that links risk to action. In banks, governance is layered and formal. Here's a typical model. The executive board sets the overall direction. What services matters most? What risk is applicable? The board risk committee defines the bank's risk tolerance and ensures regulatory alignment. Below that, a security or GRC committee runs strategy, monitors control effectiveness, and tracks KPIs. Finally, working groups roll up their sleeves, dealing with patching cycles, IAM rollout, or exception approvals. These structures ensures alignment from the top down. So when regulators like PRA or FCA knock, you are ready. Policies and frameworks are your anchor. They tell everyone, this is what you do, this is why, and this is how we do it. Without governance, you get inconsistency, shadow IT, and audit failures. So whether you are in a global tier 1 bank or a local building society, clear governance lines are simply non-negotiable. And this is where governance gets real, metrics and exceptions. Let's start with monitoring. In a bank, governance teams don't just ask, are the controls deployed? They ask, are they working? Are they current? Are they reducing risk? So we track things like how many critical vulnerabilities are still unpatched. What percentage of endpoints have critical EDR agents? Are all privileged accounts reviewed regularly? These metrics are often shared in monthly risk dashboards, audit committee updates, regulator assurance packs. Now let's talk about a bit about exceptions. Not everything goes by the books. Maybe a legacy payment system can't be patched immediately. Or a third-party integration does not support multi-factor authentication. When that happens, you raise an exception formally. First, risk and compliance assess it. Then based on delegated authority, someone decides accept it, mitigate it other way, or escalate it. In banking, critical exceptions, especially involving customer data, payment systems, and regulatory breaches, must go to senior level. Often the chief risk officer, the CRO, or to the board risk committee. It's not just paperwork. It's about protecting the business without blocking it. Let's close the governance loop now. You have set direction, monitored performance, and handled exceptions. Now it's time to review and improve. Good governance is never static. In banking, regulators expect evidence of learning from incidents. For instance, phishing, fraud attempts, and from audits and red team results, and from incident-wide threat trends. For example, after SolarWinds compromised, many banks updated third-party risk policies and endpoint detection strategies, even if they were not directly affected. That's the first half, policies and controls. What about the second half? The second half is people. Do you have the right skills on your GRC team? Enough risk analysts? Do they understand cloud, API, security, emerging threat for that matter? Frameworks like CIISEC, Chartered Institute of Information Security in UK, or NICE, National Initiative for Cybersecurity Education in USA, help map roles to competencies and expose any training gaps. Smart banks also track KPIs like percent of risk resolved on time, percent of incidents that triggered a policy or control change, percent of GRC staff with up-to-date certifications. Because governance is not just about process, it's about having people who can run the playbook under pressure.